Private placement life insurance, also known as PPLI, allows high net worth investors to hold an investment portfolio inside a privately issued life insurance policy. It can support tax efficient investment growth, succession planning, and centralized wealth administration, but only when the policy is correctly structured across every relevant jurisdiction. My name is Shiraz Waheed and I'm the co-founder at Lepidus Wealth. And in this video, I'm going to explain how the PPLI works, why wealthy families use it, and how investments are managed inside the policy, as well as where trust and foundations may fit and what you need to consider before establishing a PPLI for yourself. PPLI is a life insurance policy designed for high net worth private clients rather than sold as a standard retail insurance product. It normally combines a life insurance benefit with an investment account whose value changes according to the assets held inside the policy. Whereas you, a trust or a foundation or any other legally accepted entity may be the policy holder. Within this policy, one or more individuals are named as the insured lives, and the nominated beneficiaries receive the policy proceeds after the insured event occurs. The insurance company issues the contract under the law of its jurisdiction, while the investment assets are generally held in a dedicated or segregated account linked to the policy. An approved investment manager manages the portfolio, and a custodian holds the underlying investments. You, as the policyholder, owns the contractual rights under the policy rather than directly owning each investment held inside it. This distinction can affect taxation, succession, creditor treatment, control, and reporting. PPLI therefore operates differently from a personally owned brokerage account, and the insurance element must remain genuine throughout the life of the arrangement. Once the policy has been issued, the policyholder pays the agreed premium to the insurance company. The insurer allocates investable amounts to the policy account after allowing for administrative charges, insurance costs, and other policy expenses. The portfolio may include institutional funds, managed accounts, bonds, securities, and certain approved alternate investments such as property portfolio. The available investment range depends on the insurer, the policy jurisdiction, tax position of the parties, and valuation requirements. The investment flexibility also remains subject to the restrictions on personal control. In jurisdictions such as United States, investor control and diversification rules are important for preserving the intended tax treatment. The policyholder may normally select an approved investment manager and agree to a broad investment mandate, but the manager must make the day-to-day investment decisions independently. Illiquid assets require additional review because private funds and unlisted investments must usually meet valuation, custody, transfer, and liquidity requirements. Personally controlled businesses, family use assets, and investments managed for direct benefits of the policyholder can undermine the structure. The portfolio therefore needs to be independently managed and properly documented. Now, one of the main reasons investors consider PPLI is the potential for tax-efficient accumulation inside the policy. In certain jurisdictions, income and gains may grow within a qualifying insurance contract without being taxed annually in the hands of the policyholder. Withdrawals, policy loans, surrender payments, and death benefits may also receive specific tax treatment. The outcome depends heavily on the policyholder's citizenship, tax residency, domicile, the location of the insurer, the policy wording, and the underlying investments. A policy that is efficient for one person may produce a different result for another family member living in a different country. PPLI may also support succession planning because beneficiaries can be named under the policy and the insurer may be able to pay the proceeds through the contractual process after death. Depending on the ownership structure and the local law, this may reduce reliance on probate and provide liquidity for taxes, family expenses, debt repayment, or balancing inheritance between beneficiaries. The structure can also consolidate eligible investments within one administrative framework involving the insurer, custodian, investment managers, and reporting providers. Some jurisdictions provide a level of creditor protection for qualifying insurance policies, although protection is never automatic across border. Timing and intent matter, and transfers made after a dispute, claim, or insolvency risk has arisen may be challenged. Now, PPLI can be owned personally, but many international families consider holding a policy through a trust or a foundation. This can separate the roles of the insured person, policyholder, controller, and beneficiary while creating a long-term governance structure. A trust may own the policy, with the trustee exercising the policyholder rights and family members included within a beneficiary class. A foundation may perform a similar role where its governing documents, local laws, and the insurer rules allows it. Using a trust or a foundation does not remove the transparency or compliance obligations. The insurer will still review the settlor or founder, trustees or council members, beneficiaries, source of wealth and source of funds, and the purpose of the arrangement. For families based in Dubai, a DIFC or ADGM foundation may form part of the ownership ownership and succession framework, while the insurance policy may be issued from another jurisdiction. Dubai can operate as a regulated center for family governance, professional advice, and administration without relying on secrecy. The ownership chain should be agreed before the assets are transferred, because moving an existing policy into a trust or foundation later may create assignments, tax consequences, reporting requirements, or new underwriting checks. Now, PPLI is generally designed for investors with substantial investable assets and a long-term planning horizon. The arrangement may involve insurance charges, policy administration fee, custody expenses, legal costs, tax advisory fee, and establishment charges. These costs need to be compared with the expected tax, succession, and governance benefits over the intended holding period. A policy can be legally valid and still be commercially unsuitable if the portfolio is too small, the investor needs frequent access to the capital, or assets require a high level of personal control. Withdrawals, loans, partial surrenders, and full surrender may each produce different legal and tax consequences. The policy must also retain enough value to cover its charges and maintains its status as a valid insurance contract. Excessive withdrawals or poor funding can cause the policy to lapse or lose its intended treatment. Carrier risk also need to be assessed, because the protection of the policy assets depends on the insurance law of the jurisdiction, the segregation arrangements, the custodian, and the contractual terms. You should understand what happens if the insurer, investment manager, or custodian failed. Ongoing compliance may include regular valuation, investment restriction, beneficial ownership records, and international reporting. Now, a cross-border PPLI structure should be reviewed under every legal and tax system connected to the policyholder. A United States taxpayer may need the policy to satisfy detailed life insurance, diversification, and investor control rules. A UK resident may need to consider chargeable event rules and the personal portfolio bond regime. Other countries may classify the same foreign insurance policy as a transparent investment account, a taxable structure, or reportable financial asset. Relocation can also change the tax result. A policy established while you live in the UAE may be treated differently after you move to the UK, Europe, United States, India, or any other country. Premium taxes, reporting requirements, withdrawal rules, and the treatment of policy loans may also change. PPLI operates within international reporting and disclosure system, and the cash value insurance policies may fall within automatic exchange of information rule. Insurers normally conduct detailed source of wealth and know your client checks. The value of the structure comes from recognized legal treatment, proper disclosure, and disciplined administration rather than the secrecy itself. Now, when it comes to setting up a PPLI, the process starts with a written cross-border legal and tax review. We, as your advisors at Lepidus Wealth, will identify the relevant citizenships, tax residency positions, domicile positions, families connection, and possible future relocation plans. We will then confirm who should own the policy, whose life should be insured, and who should receive the proceeds, and whether a trust or a foundation should be involved. The proposed investments are then reviewed for eligibility, liquidity, custody, valuation, and investor control concerns. Some existing investments may need to be sold and contributed as cash, because not every insurer can accept a direct transfer of assets. The next stage is to compare insurance companies and the policy jurisdictions. The review should examine regulatory strength, asset segregation rules, policy wording, investment flexibility, surrender position, and the way insurer handles future changes in residence. After the policy is approved, the policyholder completes the underwriting, compliance, and source of fund processes. The investment manager receives a formal mandate, the custody account is opened, the premium is paid, and the portfolio is invested within the approved limits. The arrangement should then be reviewed whenever the family circumstances change, investments and ownership structures, residency, or succession planning face any changes. Now, PPLI may be suitable for an investor with a sizable liquid portfolio, a long-term investment horizon, cross-border succession objectives, and a willingness to delegate day-to-day investment decision to an approved manager. It may also help families that require life insurance liquidity alongside centralized portfolio administration and formal succession arrangements. It may be unsuitable if you need direct control over individual transactions, intend to use underlying assets personally, expect to withdraw most of the capital in the near term, or may relocate without continuing tax advice. It can also become inefficient when the policy, legal, and advisory costs are too high in relation to the portfolio itself. Ultimately, PPLI should be assessed as one part of the wider family wealth structure. The policy, the trust, or the foundation, holding companies, will, and investment strategy should all support the same long-term plan. Now, if you want our help and would like to explore whether a PPLI structure can suit your situation, you can request a personalized asset protection plan by clicking the link in the description below. That's it for today, and I will see you in the next video.